Now is the time to start tax planning, not April. If you want to save money on taxes, you need to be proactive. Your tax preparer doesn't have a magic wand. Uh, my name is Anthony Brister, and this is a wealth planning podcast with Brister Law. Today is the first episode of year-end tax strategies. We'll be posting these throughout the end of the year. We've got about 9 weeks left. So if you do want to make a difference in what you owe come April, you need to have a plan. Uh, we have tax planning meetings available till the end of the year. Go to bristertaxlaw.com, schedule a comprehensive consult, or pay attention, like, and subscribe to get the rest of my year-end strategies. So today we're going to go over 5 strategies for small business owners and what you should be doing before the year end. Those 5 strategies are: first, make Excel. Second, get your books organized. Third, consider an S-corp. And fourth, if you have an S-corp, adjust your payroll. And then fifth is to have an annual meeting, have meeting minutes, and make sure your LLC is in compliance. So first, let's get out of startup mode. Let's make a sell. In order for you to start taking ordinary and necessary deductions for a business, you have to have a business. And one very good indicator is that you did make a sell. So to unlock those deductions, make a sell, go sell to your friend, family member, whoever it is, but you need to make a sell before year end so that you can start writing off things that you're using for your business. Secondly, if you are making sales and you've got expenses, get your books organized. Be sure you're not commingling personal and business expenses, but also be sure to have either an Excel or some other type of form or software organizing all of your income and expenses. Personally, I like using QuickBooks Online because I can have my bank statements feed directly in to QuickBooks Online and then categorize those income and expenses and generate reports that I need. You could also use Excel, but don't bring a shoebox of receipts to your accountant come April and expect them to do magic, right? You can only do what you have, but also, it just adds a lot of time and sifting, and that's another cost that adds up when it comes to preparing your taxes. So do the groundwork, organize your income and expenses so that we can have a good picture of where you're at and be able to think strategically. If you need a place to organize it, or if you're looking for a software, I've got a referral link down for QuickBooks Online. You get the first few months at a discount. Try it out. I highly recommend it, and it is what I use in my personal businesses. Third tax strategy that we're going to talk about is the S-corp election. Now, this isn't for everybody, and really who should be thinking about the S-corp election are business owners who are active. So not real estate owners, it's not for your rentals, but if you've got an active business, this entity might be for you. And the threshold, really, I tell my clients, is around if you're making $50,000 net, so after expenses, this entity is going to save you a lot in self-employment taxes. If you're making under $50,000, there's some admin expenses. There's a cost of another tax return. It might be more advantageous, and it is more simple to just keep this as a Schedule C business. But if you're netting more than $50,000, the admin, tax prep costs, these tax savings outweigh those costs, generally speaking. So the S-corp starts to make sense. Now, if you are already in an S-corp, the fourth thing that you should be doing is adjusting your payroll accordingly to your profits and your distributions. For an S corporation, you must take what's called a reasonable salary, and that can fluctuate from year to year depending on your profits, how many distributions you're taking, and what kind of role you're in. So we want to be reviewing your annual salary each year. Also, depending on your retirement strategy, healthcare needs, things like that too, you might want to adjust your salary up or down. For those solo entrepreneurs, a solo 401k is a great tool to save for retirement, and you can put away a lot of money in there. So adjust your payroll accordingly, talk to your tax advisor where you should set that, look at industry standards, and also your profits and distributions. The fifth thing that I think all business owners should be doing is have an annual meeting. One, it allows you to start deducting things like travel, meals, expenses, things like that. Two, you could also personally enjoy where you go to your annual meeting. A lot of people talk about getting your family members on your board of advisors and deducting the holidays. Now, if you're going to do that, you do need to follow the rules, make sure that you have a business purpose and you can substantiate the time and business purpose. But certainly, if you're available to do that, got your family members on the board, take that deduction. Um, Not only does it save you money, but it's also a corporate formality and can help in a veil piercing case. So it's also a form of asset protection. Um, you're going to take the meeting, but you also want to make sure that you're also taking meeting minutes so you can substantiate that meeting. And then lastly, too, uh, you want to make sure that your LLC is in compliance with the state. Um, so make sure to have your annual reports filed. You make sure you've got separate bank accounts, all of these corporate formalities. Make sure that you're ticking that off too, and be discussing that at your annual meeting so that your LLC is protecting you. So that's 5-year in tax strategies for you small business owners. Stay tuned. We've got about 20, 25 more that will probably drop before the year end. Don't forget to like and subscribe, follow. If you got any questions, please feel free to comment. If you got any thoughts or you want to hear something from us, please comment. Please share with anybody, and help get this out here. So my name is Anthony Brister. This is a Wealth Planning Podcast with Brister Law. Thank you.